Hey everyone, thanks for joining me today. Let's jump right in. Why is Bitcoin so celebrated as a store of value, yet so unlikely to catch on as everyday spending money? To guide us, we'll lean on insights from Andrew Hohns, co-author of the BitBonds white paper, CEO of New Market Capital and Battery Finance, and a featured speaker at the upcoming BTC Las Vegas conference, and weave in perspectives from across the crypto world. Andrew and his colleagues proposed BitBonds, a way for Treasury to tap Bitcoin's upside to lower borrowing costs. That same deep focus on Bitcoin's economic role informs his view on why it's an unlikely medium of exchange. Andrew often points to Gresham's law, the centuries-old idea that people hoard good money and spend bad. As he puts it,
Bitcoin is very, very good money, so people will hoard it rather than use it. But
every Satoshi you spend could have appreciated 10x or 20x tomorrow. Why would anyone part with it? Layer on the tax tailwind that turns spending into a taxable event, and everyday transactions become a paperwork nightmare. The IRS treats Bitcoin as property, so each time you buy your morning coffee with BTC, you're theoretically triggering a capital gains report. Andrew's blunt verdict:
every time you use Bitcoin to buy or sell something, it becomes extremely burdensome to do that, and it's totally impractical.
First, there's wild price swings. Academic studies show Bitcoin's volatility is roughly 10 times greater than that of the euro or yen, so extreme that it hobbles Bitcoin's role in payments and leaves it with limited use outside of speculation or hedging. Then comes scalability. Bitcoin's base layer handles only about 7 transactions per second, compared with Visa's thousands. At peak demand, you can end up waiting minutes or paying high fees to get confirmation. Those delays and costs are enough to kill any hope of frictionless coffee shop payments. Speaking of fees, Bitcoin transactions aren't tied to how much you send, but to the data size. That means sending $5 or $5,000 can cost anywhere from a few cents to over 50 during congestion, hardly conducive to microtransactions. On the flip side, stablecoins have emerged to address this need. Pegged to the dollar or other assets, they trade hands quickly and predictably, making them a more practical on-chain medium of exchange, even if they lack Bitcoin's deflationary appeal. Pulling it all together, Andrew's core thesis is that Bitcoin's true calling is as a store of value, not a day-to-day currency. He highlights 4 key pillars that make it unmatched for wealth preservation. It's finite, 21 million supply cap, divisible, down to 100 million Satoshis, portable and censorship resistant. You can move it across borders at will. No central authority can dilute your holdings. So where does that leave us? Don't expect Bitcoin on every checkout terminal anytime soon. Instead, brace for continued innovation around Layer 2 solutions like Lightning, and watch as stablecoins fill the payments gap. Meanwhile, Bitcoin will keep carving its niche as a hedge against inflation and a strategic reserve, even at the state and federal level, as Andrew champions with BitBonds and other initiatives. That's our deep dive into why Bitcoin shines as digital gold, yet trips over hurdles when it comes to your everyday spending. If you've enjoyed this breakdown, hit subscribe and drop your thoughts below. How do you use Bitcoin, and where do you see it fitting into the payment landscape? Thanks for watching, and I'll see you next time.